What is the best indicator for profit from trading? Have you ever found yourself asking this question? Welcome to the world of trading, where indicators are the compass guiding traders through the unpredictable seas of the market. Trading indicators, these powerful tools of prediction, are vital to navigating the financial markets. But with so many indicators to choose from, which one is the most effective in boosting your profits? It's like finding a needle in a haystack, isn't it? You're on a journey, seeking that golden key that unlocks the door to maximum profit. But fear not, because we're here to illuminate the path. In this video, we'll delve into the realm of trading indicators, exploring their significance, and ultimately, revealing the best indicator that can help you reap the highest profits from a single transaction. So, are you ready to embark on this exciting journey? Stay tuned as we unravel the secret to maximizing your trading profits. So, what exactly are these indicators we're talking about? Well, let's get into it. In the world of trading, indicators are like the compasses of the financial sea. They're tools that traders use to help them make informed decisions about when to buy or sell. You see, trading isn't just about gut feelings or hunches. It's about using data and analysis to guide your moves. There are two main types of trading indicators: leading and lagging. Leading indicators are those that aim to predict future price movements. They're like the fortune tellers of the trading world, giving you a glimpse into the future. However, just like fortune tellers, they're not always 100% accurate. On the other hand, we have lagging indicators. These indicators look at past market trends and data. They're like historians, providing you with a detailed record of what has happened before. They don't predict the future, but they can give you a pretty good idea of what might happen based on past behavior. Now, within these two categories, there are tons of different types of indicators. There are moving averages, which smooth out price data to help identify the trend. There are oscillators, which can tell you if a security is overbought or oversold. There's the relative strength index, or RSI, which measures the speed and change of price movements. And that's just scratching the surface. But why are these indicators so important? Well, imagine trying to navigate a ship without a compass or a map. You might have an idea of where you're going, but without those tools, it's a lot harder to get there. Indicators are the compasses and maps of trading. They help traders see where they're going, understand where they've been, and make informed decisions about where they should go next. Now that we understand what indicators are, let's dive into the best one for profit. Stay tuned, because this is where it gets really interesting. Drumroll, please. The best indicator for profit from trading is the relative strength index, or RSI. Now, you might be wondering, what's that? Well, let me enlighten you. The RSI is a momentum oscillator that measures the speed and change of price movements. In essence, it helps traders identify when a financial asset is overbought or oversold. Why does this matter? Because it can offer a hint about a potential price reversal. This means you can make a move before the rest of the market catches on. That's right, it's like having a secret weapon in your trading arsenal. Pretty cool, huh? But why is it considered the best? Simple. It's because of its versatility and accuracy. Whether you're looking at stocks, forex, or commodities, the RSI can provide valuable insights. Intrigued? Well, you should be. Let's delve deeper into the workings of the RSI. RSI sounds fancy, doesn't it? But how does it work? Let's delve into the intricacies of the Relative Strength Index, or RSI for short. This momentum oscillator was developed by J. Wells Wilder in 1978. It's a tool that helps traders identify potential overbought or oversold conditions in price movements. So, how do we calculate RSI? It's not as daunting as it might seem. The RSI is computed using the average gains and losses of an asset over a specified period, typically 14 periods. We then use these averages to calculate a relative strength, which is the ratio of average gain to average loss. The RSI is then plotted on a scale of 0 to 100. Now let's talk about how to interpret this scale. When the RSI is above 70, it suggests that the asset might be overbought. This could indicate a potential price decrease in the future. On the flip side, when the RSI is below 30, it could mean that the asset is oversold and a price increase might be on the horizon. But wait, what about the range between 30 and 70? This is considered the neutral zone. Movements within this range are often disregarded by traders as they don't provide strong enough signals for trading decisions. Remember, the RSI is not a standalone indicator. It's most effective when used in conjunction with other technical analysis tools. It's also worth noting that while the RSI is a powerful tool, it's not infallible. Like any indicator, it has its limitations and should not be relied upon exclusively. So why do traders use the RSI? Well, it offers a simple way to measure the speed and change of price movements. It's a helpful tool for identifying potential reversal points in the market before they happen. Understanding how RSI works is the first step. The next is knowing how to use it. Now that we know how RSI works, how do we use it to maximize our trading profits? The first step to using the Relative Strength Index, or RSI, as a tool for profit maximization is understanding its key thresholds. These are typically set at 30 and 70. The 30 mark represents oversold conditions, while the 70 mark represents overbought conditions. When the RSI crosses below 30, the asset is often considered oversold. This could suggest that the asset has been on a downward trend and could be due for a price correction or a reversal. This is a signal for traders to consider buying the asset, as its price may increase in the near future. On the other end of the spectrum, when the RSI crosses above 70, the asset is often considered overbought. This could indicate that the asset has been on an upward trend and might be due for a price drop or a reversal. This is a signal for traders to consider selling the asset, as its price may decrease in the near future. But remember, these thresholds are not set in stone. Some traders might adjust them to better suit their trading strategy or the particular market conditions. For instance, during a strong uptrend, the asset might remain overbought for a longer period. In this case, selling just because the RSI crossed above 70 might not be the best move. Similarly, during a strong downtrend, the asset might remain oversold for a longer period. Here, buying just because the RSI crossed below 30 might not be the best decision. That's why it's crucial to combine the RSI with other tools and indicators, and not to rely on it solely. It's also important to consider the overall market conditions and to always have a solid risk management strategy in place. And there you have it, the secret to using the RSI for maximum profit. We've come a long way, haven't we? From our initial introduction to the complex world of trading indicators, to our in-depth exploration of the Relative Strength Index, or RSI. This journey has been filled with insights and understanding. The RSI, as we've learned, is more than just a tool. It's a compass, guiding us through the turbulent waves of the financial markets. Let's take a moment to revisit the key points about this powerful indicator. The RSI, a momentum oscillator, measures the speed and change of price movements. It's a tool that helps us identify potential overbought or oversold conditions in the market. Remember, an RSI reading above 70 suggests an overbought condition, while a reading below 30 signals an oversold condition. But keep in mind that these are merely guidelines, not hard and fast rules. We've also learned how to use the RSI to achieve maximum profit. It's about looking for divergence, where the price of an asset and the RSI are moving in opposite directions. This often signals a potential reversal, an opportunity to make a profitable trade. Remember, the RSI is like a weather vane, pointing to where the market winds might blow next. But let's not forget that while the RSI is an incredibly effective tool, it's not infallible. It should be used in conjunction with other indicators and strategies. It's only one piece of the trading puzzle. So, as we wrap up, I encourage you to apply what you've learned. Take this knowledge, use it, refine it, make it your own. Trading, like any skill, requires practice and patience. And remember, knowledge is power. The more you understand about the market, the more informed your trading decisions will be. So, what's the best indicator for profit from trading? It's the one you understand and use correctly. It's the one that helps you navigate the market, that gives you confidence in your decisions. It's the tool that, when used wisely, can help you maximize your profits and minimize your losses. Remember, the best indicator for profit from trading is the one you understand and use correctly. Happy trading. Happy.